Hello everyone. Welcome to the continued session of Final Accounts of Non-Trading Concern. In this video, let us discuss something about capital expenditure, revenue expenditure and deferred revenue expenditure. What is a capital expenditure? Capital expenditure is the expenditure whose benefit is not exhausted in the year in which it is incurred and the benefit will be postponed to more years. Such an expenditure is called as capital expenditure. The very feature of capital expenditure is they are non-recurring in nature. They are incurred in once in the lifetime of the business or in least time in a life of the business. So they are called as non-recurring expenses or capital expenditure. In other words, such capital expenditures are the expenditures which increase the productivity or the income earning capacity of the assets. So these are all capital expenditures. Let us see which are all the examples for capital expenditure. The first one is cost of fixed or permanent assets. The cost of land, cost of building, machinery, furniture or goodwill, any of the intangible assets are the examples for capital expenditure because the assets, fixed assets are purchased by the non-trading or trading concerns once. Then the second example is cost of additions or extensions to the existing fixed assets. Any cost of extensions incurred for extension of the lands or any additions to the machinery, etc. are the examples for capital expenditure. The next is any expenditure incurred in connection with the acquisition or purchase of fixed assets. For example, legal expenses incurred on acquisition of land or the brokerage paid by a company while investing in the shares are examples for capital expenditure. Then the next one is any expenditure incurred in bringing the fixed assets purchased to the business premises. Any carriage expenses or freight charges which is paid for bringing the fixed assets from the place of purchase to the business premises is an example for capital expenditure. Then any expenditure incurred in installing fixed assets. See, for example, the cost of installation of machinery is an example for capital expenditure. Then what will be the treatment of such capital expenditure? The capital expenditure is treated as an asset so that they have to be shown on the asset side of the balance sheet. Whenever an expense incurred for the purchase of fixed asset or installation of the same to bring the purchased fixed asset into the business premises, such expenditure should be debited to the concerned asset account but not to the concerned expense account, so that they have to be shown on the asset side of the balance sheet. Hope you know something about capital expenditure now. Then let us move to the next concept, that is revenue expenditure. Revenue expenditure is an expenditure whose benefit will exhaust in the year in which it is incurred. Such expenditures are recurring in nature. See, for example, cost of the goods sold. We are purchasing the goods for the purpose of sale and the cost of purchase of goods will be considered as a revenue expenditure. Any expenses such as carriage, freight charges incurred in bringing the goods purchased to the place of business. Suppose carriages incurred for the purpose of purchasing a fixed asset will be treated as capital expenditure. Any carriage charges which is incurred for purchasing a goods, it is considered as revenue expenditure. Then cost of raw materials which are used for the purpose of manufacturing the goods will be considered as revenue expenditure. Then any expenses incurred in manufacturing of goods and services like cost of the power, factory rent, etc. are the revenue expenditures, and all the expenses which are incurred for the purpose of day-to-day management of a business are considered as revenue expenditures. As I said earlier, all the revenue expenses are of recurring in nature, and while comparing to the amount, it is quite less while comparing to the capital expenditure. How we can treat such revenue expenditures? They are all the expenses to a concern. Therefore, they are charged to the revenue account of a trading or non-trading concern. As we are in non-trading concern, such expenses are shown on the debit side of income and expenditure account of a non-trading concern. If it is a trading concern, these expenses are to be shown on the debit side of profit and loss account or trading account, as the case may be. So this is all about revenue expenditure. Let us move to the next concept, that is deferred revenue expenditure. The very name itself says it is a revenue expenditure, but it is deferred. What is the meaning of deferred? It is postponed. In the sense, these expenditures are the heavy expenditures of revenue nature incurred for getting a benefit which extends to 2 or more years. In the sense, deferred revenue expenditures are the revenue expenditures with heavy amount, and the benefit of such expenditures will not exhaust in the year in which they are incurred, so that they are not completely written off in the year in which such expenditures are incurred. They are, a portion of such expenditures will be written off and portion of such expenditures will be deferred or postponed. Why the term deferred is used here? Because writing off of such expenditures are deferred or postponed, because the amount of such expenditures is huge. We cannot charge entire amount to the year in which it is incurred. We have to spread such expenses to more years. And the second reason is the benefit of such expenditure is not exhausted in the year in which it is incurred. We can get the benefit in 2 or more years, so that the writing off of such expenditures are postponed or deferred. See the examples. Huge amount spent on advertising while we are introducing a new product. Heavy expenses incurred for shifting the place of business to a convenient place. Then preliminary expenses, the expenses incurred while forming the company or any of the concerns. Then brokerages paid while issuing the shares, and underwriting commission incurred or paid by the company at the time of issue of shares. What will be the treatment of such expenditure? If we write off the expenditure, such part has to be debited to the revenue account, that is income and expenditure account. The remaining portion which is not written off should be treated as an asset and to be shown on the asset side of the balance sheet. I discussed about revenue expenditure, capital expenditure and deferred revenue expenditure. In the next session, I will meet you with the segregation or finding out which expense is the expense of which nature. Thank you.